Have you ever noticed something strange about financial markets? When headlines warn about instability and prices move unpredictably, many people start to panic. Investors check their apps constantly and news channels repeat the same dramatic words again and again. Suddenly, a thought appears in many minds. Maybe I should sell before things get worse. But behind the scenes, something very different often happens. While most investors react emotionally, wealthy investors approach markets in a completely different way. They don't see volatility the same way others do. In fact, some of the biggest fortunes in history have quietly been built during uncertain times. The real question isn't whether uncertainty appears. It always does. The real question is how investors respond. One major difference between wealthy investors and average investors is emotional control. Fear spreads quickly, and many imagine worst-case scenarios, making decisions they later regret. Experienced investors understand that short-term market reactions are often emotional, not rational. Prices can swing dramatically based on feelings rather than fundamentals. Calm, patient investors see opportunities where others see chaos. Another key strategy is diversification. Wealthy investors rarely rely on a single type of investment. They spread their wealth across stocks, real estate, businesses, and sometimes commodities like gold. The goal isn't to predict the future perfectly, it's balance. When one asset struggles, another may remain stable or grow. Diversification reduces risk, like a structure supported by multiple pillars instead of just one. Long-term thinking is another hallmark. While most focus on weekly or monthly fluctuations, rich investors think in decades. They ask, where might the economy and businesses be in years to come? Over time, productive assets grow alongside the economy. Patient investors who stay invested benefit from long-term progress, making short-term volatility less important. Selective patience is also key. They don't rush into every opportunity, nor do they disappear from markets. They observe, analyze valuations, and invest thoughtfully when strong companies temporarily trade at lower prices. At the same time, they avoid overreaction. Headlines are designed to grab attention, but wealth is rarely built by responding to every news cycle. Liquidity and optionality also matter. They keep part of their wealth accessible to seize opportunities when they arise. Patience and discipline define their approach. Wealth grows slowly through years of disciplined investing and compounding. They understand temporary setbacks are part of the journey. Mistakes happen, but diversification, long-term thinking, and patience protect them from emotional decisions and allow steady growth. The next time markets feel chaotic, remember, uncertainty is normal. What matters most is the strategy you follow. Now, I'm curious, have you experienced market uncertainty? Did you stay patient, or did fear take over? Share your story in the comments. I read every one, and some may inspire future videos. If you enjoy learning how money, psychology, and investing work, subscribe to the channel. Every week, we break down financial ideas that help you think clearly about wealth and long-term investing.